Hello, everyone. Welcome to the first webinar in the Financial Success Series. My name is Sudha Subramanian, and I'm a product manager at Strikedeck Natalia. Strikedeck has always thought itself as being a leader in the CS space, and we've always tried to contribute to the body of knowledge in this field. Our latest offering is the webinar series, where we will have a panel of experienced customer success leaders talk about key concepts and best practices. In today's webinar, we will focus on understanding key financial metrics and their impact on CS strategy. Now, to start with a little introduction on Strikedeck Natalia, Strikedeck is a customer success platform that helps businesses deliver outstanding customer experiences while maximizing the value of their customer relationships. Strikedeck's customer success platform equips customer success professionals with the tools to understand your customers' usage trends, harness business analytics, assess customer health, prevent churn, and foster key business relationships, all in one cohesive platform. Before we start this webinar today, we'd like to understand our audience a little better. So please, could you go ahead and answer this poll for us? While that's going on, let me give you an introduction to Tom Lipscomb. Tom Lipscomb will be leading our webinar today. Tom is the founder of The Successful Customer, a Bay Area-based management consulting firm. Tom has over 20 years of experience as an executive in both Fortune 50 companies and startups. Tom's strategy has always been about delivering quantifiable business value to his customers. So Tom is incorporating that strategy today, and in today's webinar, Tom will discuss the financial foundations for building a successful customer success strategy. Welcome to the webinar, Tom. The floor is yours.
Oh, Sudha, thanks so much. Really appreciate the introduction. Always a pleasure working with Strikedeck. Oh, the poll just popped up. So the majority of you are CS management, parts of the leadership team, and sales and others. So it's great to have you all here with us today. I'm going to start out by giving you a sense for the agenda today. We are going to talk about 4 major topics. The first of which just talks about LTV relative to recurring revenue companies, LTV being customer lifetime value. Then we're going to move on to customer success and LTV, what the relationship is between the two. After that, because it's a financial series, we're going to look at some math. How do you calculate LTV? And maybe most importantly, why you need to know those ways, why those formulas are important to you almost on a day-to-day basis. Before we get there, though, I just want to give you a little sense for the successful customer. This is not an infomercial. I think it's just relevant to this talk today, and actually the whole series we're going to do. So at the successful customer, we focus on 1 fact and 2 questions. The fact is net retention is the factor, the single factor, having the greatest impact on your valuation. The 2 questions are, how much money should you spend doing that, and where should that money be spent? We'll also really focus on strategies and tactics, kind of going back and forth between the 2. I love this quote from Sun Tzu. It's kind of foundational to what we do. Sun Tzu, 6th century BC, Art of War author. Anyway, he makes this quote about strategy, which is strategy without tactics is the slowest route to victory, while tactics without strategy is the noise before defeat. So Sun Tzu is one of the greatest strategists of all time. So it's not like he doesn't believe in strategy and tactics. It's just that there's an interrelationship between the 2, where you go back and forth kind of in an iterative way, which is what we do at the successful customer.
So, Tom, what's your opinion? Do you think you start with strategy and then add in the tactics? Where do tactics come in this whole picture?
Yeah, so really good question. So the way we approach it is we start with strategy. You hear a lot of people talking about how you justify the cost of customer success, but if you look at other parts of the organization, we know how much we spend on sales and marketing. There's a relationship between that and the growth rate. We understand what our target needs to be for gross margins, but we don't necessarily look at customer success the same way, and I think we need to. Actually, that's going to be the focus of the second webinar is how much should you spend, which is really a strategy question for the company. But then that leads into tactics. Does that help give you a better sense?
That makes sense.
Okay, super. So let's jump into the first topic, the importance of LTV to recurring revenue companies. I'm going to start out with a term that many of you may be familiar with. It's CAC, which is a customer acquisition cost. But we're not just going to look at the number, we're going to look at the ratio. So how much do you spend for $1 of new revenue? And we're going to look at this metric kind of in the context of the evolution of customer success. So as I said earlier, customer success is constantly evolving, but it's different today. And there's certain inflection points that have made it what it is. And one of them happened at a Salesforce executive offsite. So this in the spring of 2005, about a year after their IPO, when this guy, David Dempsey, who ran Europe, came in. David Doomsday Dempsey, Dr. Doom, picked up a lot of names after this announcement. He came in and said churn is at 8% a month. So big deal. Actually, this is when they started Customers for Life. And if you look at their CAC ratio, at that time they were spending, $1.19 to $1.20. They backed off a little bit after this announcement. And these numbers are kind of in line with what companies spend today. I think the average being about $1.15 from what I've seen. So $1.15 is spent for each dollar of new revenue. So when you talk to Salesforce executives, one, Customers for Life is really about making customers successful so you could retain them. So very much the way we view customer success. And it took about 2 years to get it really reducing churn in a significant way. And that's something really interesting happened with their CAC ratios. As you can see from this graph, they kind of went through the roof. 2010, over $2.50. And then going down, but ending up at a $2 number, or about a $2 number per dollar of revenue. So to me, the logical question is, was this a smart strategy? And I think we all kind of know from history that it was. This is their market capitalization or valuation, which pretty much went through the roof. So what does this have to do with LTV? What made both the ability to spend all this money and the stock price go up or the valuation goes up? It was all customer lifetime value.
So a quick question for you here, Tom,
sure.
if I may interject. So you've shown us this example of Salesforce. Now, is this fairly typical? So are we saying that this relationship that you showed here persists across all SaaS companies, maybe across all companies in the space? So can you throw some light on that?
Yeah, so most VCs will tell you that ratio should be about $1. The reality is people spend more than that, and often people spend a lot more than that. Like I mentioned earlier, we'll go into that in more detail in future parts of this series, but it's not uncommon. If you look at Thomas Tungus, he'll tell you that the high multiples and price to earning ratios for SaaS companies it's impossible to explain in any other way than looking at customer lifetime value. So it's all forward facing. And honestly, those valuations are based on less risk, right? A SaaS company is going to start with kind of the same amount of revenue as they ended it with last year versus a traditional business that really needs to sell to get to that number. So let me move on from there. And we're going to talk about the next topic, LTV and customer success. And to do this, I need to give you context of what I believe customer success is. One, I think customer success is actually all about LTV. Obviously, we have other metrics, but that's the focal point financially. And also, I know sometimes customer success does pre-sales, but pre-sales activities are done with prospects, not with customers. All these other things are defined as activities with customers. And therefore, I look at all of this as customer success. So when we talk about financials, this is the way we'll approach it. And actually, customer success does not end here. It goes on, which actually has really important financial implications when you're doing things such as your strategy and then the application of that amount of money to the specific areas in which it should be spent, your focus areas.
So, Tom, seems to me that what you're saying is this is all customer success. And I was just wondering, what about sales? What about professional services? What kind of role do they play post-sale in the customer journey?
Yeah, so that varies. I will say a lot to everyone, it depends. And that's not meant to be vague. It's just honestly, we need to look at it. But when I look at things like sales and account management or professional services, I look at them as names. People call them customer success managers and client success managers. And I'm looking at this at a slightly higher level. This is all customer success. I honestly don't care who participates and what roles. I usually don't focus on the names of organizations because I just don't want to get into a silo mentality. So if you use sales for renewals, great. We just need to understand how much we spend doing a renewal, et cetera. And if having sales do it makes sense, which in many instances it does. Does that answer your question, Sudha?
Yeah, so that makes sense. But I think this might be a good time for us to poll our audience to see how many of them actually compute LTV and in what scenarios. So let's launch our next poll.
Sure. So part of the interest in this poll is gives us an indication of what you use LTV for. Obviously, if you don't calculate it, you don't use it for anything. But sometimes when it's once a year, it's for investors. So I'm just trying to get a sense for where the audience is at. So we close the poll. Okay, a bunch of people don't calculate it. So I think for those of you, you'll find it really interesting. Actually, any of you in the 3%, any of you actually, if you ever want to reach out to me, connect to me on LinkedIn, really interested in these results and why you do it. For now, let me go on and talk about why I think it's really important. Yeah, so, and to do that, we'll get to our third part where we're going to get into the math. Financial guys do a lot of math. I'm going to start though with definitions because I think that will help you understand. So there's three ways I look at calculating it. So there's this one, LTV is a total amount of money a customer is expected to spend on your products during their lifetime, which intuitively kind of makes sense. You can approach it with a very simple formula, which is ARPA, your average revenue, your ARR per customer divided by churn. So $20,000 ARR, 10% churn, the customer is going to be worth $200,000 to you over your lifetime. But there's a formula that I think is a little bit better, and that includes net profit. And we'll show you how to do that actually. So it's pretty simple. You just take the same ARPA number, you multiply it times gross margin percent, and you divide it by churn. If you think about it, this makes sense. If you're losing money on a customer, there's not a lot of customer lifetime value there. If your margins are less than someone else's, honestly, the value of those customers, like if it's a competitor, the value of those customers to you, if your competitor's gross margin is higher, is more valuable to you. So we really have to include this. But there's another formula that I think we'll go over it in detail. It makes a lot of sense, or at least we should know about it and calculate it this way. And this has to do with present value of future cash flows. So let me get into this equation, which, whatever, it's more complex. It may scare people off, but I think by the time we're done, you'll understand its importance. Without going into G, which is cool because it lets you do negative retention and those kind of things, or negative churn numbers. We're going to just focus on the discount rate point. So did I hear you?
Let me interrupt. Sorry, let me interrupt you. Question That is a scary formula. I did want to talk about discount rate, but before that, I had a quick announcement to our audience. I am seeing questions pour in. We will have a Q&A session at the end of Tom's presentation, where Tom will take questions and have an answer for them. Should we have a high volume, Tom will choose a few questions to answer, but Tom assures us that he will get to each and every question and email an answer for those questions to everybody. So coming back to my question, Tom, you talk about discount rate. Can you tell us what that is, and how does somebody come up with a discount rate that's valid for
Sure.
their particular model?
Sure. So discount rate, a lot of people use like a cost of capital. And so if you look at WACC, there's weighted average cost of capital that's calculated by a number of sources. And by your industry, it'll tell you kind of what this number should be. For SaaS companies that are kind of well into expansion, 8.5%. What you have to remember is that number is just really high for early stage companies, like 25%. Which, if you look at this formula, it just kind of wipes out the churn or the variations in your churn. And just to go into like discount rate, so this is discounted cash flows. The best way to think about that is this: if I asked you to give me $10,000 today, and I said in 10 years I'll give you 10 grand back, I'm pretty sure none of you would do it. If you would, please send me an email for sure. And that's just because like $1 today is worth more than $1 in 10 years. And then if you look at startups, like, or if you look at me, there's a risk that I won't be here in 10 years, which of course I will. But if you look at average startups, a lot of them will be gone. So it's really important to discount that money, which is what we're going to look at next and how that works. So first, we're going to look at gross margin by customer segments. This is something, actually, this is data from a client of mine, and the tiers on the bottom are just segments of their customers. I hate to say who's most important, but that's kind of the way it laid out. So if we look at tier one, it's kind of what we expect. And it was what they expected. It's the greatest LTV. Tier two goes down a little bit. Tier three goes down a little bit. And let me interject here real quickly. Hopefully we'll have a chance to discuss this in more detail, but these are the kind of numbers you look at when you want to work with the leadership team and ask questions like, should we really be selling to these accounts? I hear customer success leaders, and I know we have a bunch on this webinar, talk about like, we want to veto a sales deal. I just don't think that's professional. But on top of it, it's just very antagonistic, right? It's like, we're going to slap sales upside the head. And is that the culture you want to have? Bringing to your leadership team numbers like this are really interesting, and other interesting numbers is what these people found out. So they did not expect this, but calculating LTV, they found out that their lowest tier customers were calculated this way, actually the most valuable. But actually, before I move on, let me ask let's do another quick poll. Just to understand how often all of you calculate LTV or calculate it. Have we seen those results up yet? Good. So once again, we saw the LTV numbers. Let's look at customer segments here. Once again, this will be a continuing theme through what we do, both on kind of these lagging indicators of, oh, wow, here's what's happened in the past. And also when we look at where we're going to spend our money going forward, where we're going to invest the money we decide to spend on customer success. Fantastic. Oh, okay. So not a lot of segmentation going on. Once again, I think you'll understand from looking at these numbers we're showing why it's important. And also, as we go through this series, you'll understand why it's extremely critical for all of us. So with that said, let's go to the last formula and look at the same numbers discounted. So kind of similar. Of course, they're going to go down a little bit because of the discount rate. What's interesting is what happens to tier four, though. now it's not as compelling. As I said earlier, it depends. So these numbers, like this is not an exact science. You look at that number now, you need to go in and understand tier 4 and why it's like tier 2 or why it's similar. Whereas the previous slide, you might have gone to the leadership team and said, boy, this is something really important for us to understand. At any rate, I'm going to introduce yet another metric, hopefully not going too fast. But this is one that a lot of VCs look at and one that the leadership team will be inherently interested in. We're going to do it again by tiers, and it's the LTV to CAC ratio. CAC this time not being actually the ratio, CAC being how much do you spend to get a new account, which is basically the sum of sales and marketing. So in this example, we look at it both ways. What's key to understand is VCs and management teams typically look at this ratio and say, we want a 3. So if you look at tier 1, it seems like we're kind of spending the right amount to get a customer. Tier 2, maybe. The discount rate makes you look at this with a little more jaundiced eye. And when we get to tier 3, like the question comes up, if you look at these ratios and they're significantly below 3, you should spend less on sales and marketing. That's just a fact. Once again, great leadership team conversation. And then tier 4, I mean, this to me is even more interesting based on the way you calculate it. If you do it the traditional way, this number of 5 says you should be spending more money on sales and marketing to get these people. Where there's a chance when you look at it discounted, the answer is maybe not. Maybe we should even spend less money on this group of customers. Once again, it's the answer is it depends, but what's critical, I think, is for people to look at these numbers in a couple of different ways and by customer segments. Anyway, that is what we really focused on today. I just want to highlight again, this is called the Financial Success Series to give you a sense for what's coming next. We're going to look at actually, we're going to look at CAC again, which once again is the sales and marketing cost, but we're going to look at a couple of other costs. So how much it costs to expand the CAC ratio, and maybe of most interest, how much you should spend to retain $1. If you look at the numbers in blue, they're actually medians from our research. We go from sales and marketing to about $1.15 per dollar, down to about 14 cents. For how much you should spend to retain $1 of revenue. And once again, that's a median value. But for this client, it was really useful because they were spending almost double that, which raises the question, why are we doing that? Are we hedging against growth? All things that we'll talk about coming up. Anyway, I hope you found this useful. Sudha said we had a number of questions. So Sudha, why don't you tee one up for me and I'll see what I can do.
Sure, thanks, Tom. So these were some of the questions that came in through chat. So some questions were, does anyone use the LTV calculation in professional services business?
Typically not, and here's the reason. I don't think they're really viewed as recurring revenue models. Yeah, it's recurring revenue. But in a way, kind of a lot of businesses are. And if you look at the price to earning ratios, it's just easier for publicly traded companies. Real recurring revenues like Salesforce, I mean, they're 100. So for every $100 you spend on a share of stock, there's like $1 of earnings. When you look at professional services, the numbers aren't that way, and it's just not viewed. It's just not viewed as a recurring revenue model, although you may sign 3-year contracts or renew every year.
Mm-hmm. So the next question was, when we look at LTV, are we calculating net or gross churn?
So for the first, you use net unless it's positive. So the other good thing about that last equation, and if you, I think I've got it on my website, but reach out to me and I'll send it to you, and the link to it. It's actually David Scott came up with that. I think they even have a calculator. Anyway, that will allow you to do negative churn. So that's the one caveat, right, is when those numbers go positive, it messes with the equations. And you can do it both ways. You know, I don't say you should present all these numbers to your management and leadership team. I think as customer success execs, it's your job to look at the numbers in a couple of different ways, interpret them, and then you're a professional, make recommendations. So I look at it both gross and net, unless of course you're net, and unless of course your net is positive, and then the equations kind of fall to the last one. Anyway, really good question.
Mhm. Another good question. If customer success LTV is measured in post-sales only, why is the cost of customer acquisition important?
Okay, very cool. Because the CAC to LTV ratio is so important and you own LTV, right? So in a way, that ratio is really focused on how much are you spending versus how much that customer is worth over time. Customer success is responsible for how much that customer is worth over time. But from a business perspective, it kind of ties together. And once again, it's not an antagonistic thing with sales and marketing. It's simply facts. Honestly, I think when you use numbers, it helps the culture. So I'm not saying sales and marketing, what are you doing? You're spending too much on this group of customers that we can't keep. I'm just saying, let's look at the numbers, and as a leadership team, let's interpret them and decide what we do. And that's best done by you guys calculating LTV and just asking for the CAC.
So another related question, Tom. So this is what Sean has to say. Do you look at LTV from the first time you see the customer, or do you look at customers over a consistent time period, such as value over 5 years or 2 years?
Okay, so we talked about early stage startups. If you look at the complex formula, the discount rate is so high it can kind of become meaningless. And then if you look at the simpler formulas, yeah, you can do it, but honestly, you got to look at your customer base and say, like, in year one, how much do I really know? I'm just starting to renew customers. Once you're stable, you look at it, or, you know, once you have a number of customers and you've been through a few cycles, you look at it on an annual basis. So I don't go and calculate LTV for the last, 3 years. Now I could do it 1 year at a time. Maybe you could do it quarterly if that makes sense to you. But I always do a years of data looking back every quarter. Because you've got to really look at what you're doing today. You're introducing new products. Hopefully you're getting better and retaining customers and upselling. So I do it regularly, taking a year's worth of data.
Mm-hmm. Thank you. So that sort of answered another question that another participant had. Unfortunately, though, we are running out of time. So what I'd like to do is thank Tom for taking the time to do the webinar with us today. I also had some information that I wanted to pass along. So for all webinar participants who are interested in a deeper dive, Strikedeck Medallia is happy to announce that Tom will be offering a few participants a complimentary 1-hour workshop. This will be a 1-to-1 workshop offered via Zoom, where Tom will work with your numbers, will work with your modeling, and sort of give you a better understanding of the metrics that matter to you. So if you are interested, here's the link that just popped up. You will also find it in the chat window. So please take a look at this. This is on the Strikedeck website. Go ahead and give us your information and we will be in touch with you. So this link will also be available in the email that will contain the recording of this webinar that is sent to you. So thank you everybody for participating. Have a great day. Bye.
Yeah, I'd like to thank everybody too. Hope you found it very useful. Look forward to seeing you at the next couple of webinars on the same topic as we expand.